Welcome to CoreLogic's Housing Market Update for March 2025. CoreLogic's National Home Value Index posted a 0.3% rise in February, ending a short-lived 3-month downturn. The February rise was subtle but broad-based, with every capital city and rest of state region, except Darwin and regional Victoria, recording a rise in values. The largest month-on-month change across the capitals was recorded in Melbourne and Hobart, both up 0.4%. These were also the markets where home values have previously been amongst the weakest. For Melbourne, the lift breaks a streak of 10 consecutive months of falling values. Conversely, the mid-sized capitals of Brisbane, Perth and Adelaide have lost their mantle as the strongest growth markets. With a monthly change of 0.2% to 0.3%, the mid-sized capitals were outpaced by Melbourne and Hobart this month. Adelaide and Brisbane are still leading the quarterly growth trend, up 1.2% and 0.9% respectively, but Perth's value growth has slowed more sharply, with a quarterly change of just 0.3%. The return to growth across Sydney and Melbourne was driven by the most expensive end of the market, with the upper quartile leading the monthly gains in both cities after recording the sharpest declines. This stronger performance is in line with historical trends, where premium housing markets in Sydney and Melbourne have been the most sensitive to rate cuts. Along with a modest rise in values, we've also seen an improvement in auction clearance rates, which have returned back to long-run average levels across the major auction markets in February. Regional housing conditions continue to show a stronger growth trend relative to the capital city counterparts in February, with values across the combined regionals index rising 0.4% over the month and 1% over the rolling quarter, compared with a 0.3% monthly rise and a 0.4% quarterly fall seen across the capital cities. However, there has been some diversity in these trends, with the monthly change favouring Sydney, Melbourne and Hobart over their regional counterparts. Improved housing conditions may also be supported by a slowdown in the flow of freshly advertised for sale listings. Counts of new listings coming to market across the combined capitals were tracking 3.9% lower than a year ago over the 4 weeks to March 2nd and 2.8% below the previous 5-year average. Total listings are up 2.6% on a year ago, but holding around 7% below the previous 5-year average. On rental market trends, national rents rose by 0.6% in February, the strongest monthly gain since May last year, but well below the 0.9% rise recorded a year ago, or the 1.2% gain seen in February of 2021 at the height of the rental boom. The pickup in rental growth through the first quarter is likely to be driven by seasonal factors, with the broader trend pointing towards a slowdown in rental growth as households become larger and net overseas migration normalizes. We can see the slowdown in rental growth more clearly in the annual trend, where rents rose by 4.1% over the past 12 months. That's the slowest annual gain since March of 2021. Despite the slowdown, the annual change in rents is tracking about double the pre-pandemic decade average of 2%. After 4 months of consistent declines where values dropped 1.9%, Sydney housing values edged 0.3% higher in February. The rise was a little stronger for houses, up 0.3%, than units at 0.2%, and was also more noticeable across the upper quartile of the market, where values rose by a larger 0.4% in February, compared with just a 0.1% rise across lower quartile values. The lift in housing values was accompanied by an improvement in auction clearance rates, rising to the mid-60% range. Prior to February, clearance rates were tracking in the mid to low 50% range. Buyers still had more choice than normal, with advertised stock levels tracking 7.6% above the 5-year average. Although housing markets look to have moved past the recent downturn, the trends from city to city and region to region remain diverse. The rate-cutting cycle is still very fresh and it's likely to be drawn out. Lower mortgage rates are clearly a net positive for housing markets, supporting a rise in borrowing capacity and serviceability assessments, but interest rate settings are likely to remain in restrictive territory for some time yet. Financial markets are expecting the cash rate to be around 3.55% by the end of the year, implying only 2 more 25 basis point rate cuts are priced in. Most economists suggest there could be up to 3 more cuts of 0.25% each this year. Even under this more bullish assessment, a 75 basis point cut would take the cash rate to 3.35%. That's still well above the pre-pandemic decade average of 2.55% and higher than the RBA's estimated neutral cash rate, which was revised lower in the latest statement of monetary policy. Until home loan serviceability improves more substantially, it's hard to see housing markets moving into a material growth trend. Markets where housing values have experienced a more significant downturn could be primed for a stronger value growth performance, given their renewed affordability advantage. Hobart, the ACT, and Melbourne have all recorded substantial declines from their 2022 peaks. More specifically, it's the premium end of these markets that has taken the biggest hit, with the upper quartile of Hobart's market down 16.4% from peak levels, the ACT's upper quartile is down 9.8%, and Melbourne's most expensive quarter has dropped by 8.9% in value. Through previous rate-cutting cycles, it's been the premium markets of Sydney and Melbourne that have responded the earliest and most positively to rate cuts. Also, a further lift in consumer sentiment would support purchasing activity. Historically, there's been a close relationship between measures of consumer sentiment and the volume of home sales. We've already seen a substantial rise in sentiment readings over the past 6 months or so, although the past few months have seen the trend flatten out. If sentiment returns to more optimistic levels, along with a subtle improvement in serviceability provided by rate cuts, it's likely we'll see buyer activity lifting. A rise in demand for housing from lower interest rates and from a sentiment boost will be partially offset by slower population growth. After peaking in the first quarter of 2023, the Centre for Population expects net overseas migration to reduce further as arrivals continue to moderate, alongside a pickup in departures as visas from the temporary surge in migrants expire. Less migration is likely to flow through to a further easing in rental demand, and over the medium term, reduced demand for home purchasing. Low levels of newly built housing should also deliver some support for housing values in 2025. Residential construction activity has seen a subtle rise across the detached housing sector, but multi-unit dwelling commencements remain well below average, with little evidence of a pickup in activity due to feasibility challenges amid high construction costs and very tight labour markets. With this positive inflection in housing values quite fresh, it will be important to monitor the trends to see if this momentum can be sustained. You can stay up to date with all the housing market twists and turns at the news and research pages of the CoreLogic website.